Imagine if borrowing money became almost free. That's exactly what President Trump is demanding, slashing interest rates to just 1%. His push for ultra-low rates is shaking up Wall Street and the crypto world alike, raising urgent questions for anyone holding digital assets. The Fed has already cut rates 3 times this year, but Trump wants more, especially with Chair Powell's term ending soon. This isn't just politics, it's a direct threat to the value of your crypto portfolio. At Crypto Insider, we break down what these moves mean for your investments, from Bitcoin to XRP. We'll show you how interest rates, presidential influence, and Fed decisions could send shockwaves through the market. Let's dive into the key forces shaping your crypto future. Think of the federal funds rate as the economy's master volume knob. When the Federal Reserve turns it down, borrowing money becomes less expensive, and cash flows more freely through the system. This single rate influences everything from the interest you pay on your credit card, to the mortgage rates offered by banks, and even the returns you get on your savings. It's the tool the Fed uses to set the tempo for economic activity across the country. Lower rates mean it's easier for families to buy homes, for businesses to invest, and for consumers to spend. Mortgages, car loans, and business financing all become more affordable, which can boost economic growth. On the flip side, when the Fed raises rates, borrowing costs climb, spending slows, and the economy cools off. A necessary move to keep inflation in check when prices are rising too fast. Over the past decade, we've seen the Fed swing from years of ultra-low rates to a period of rapid hikes. And now, as economic growth shows signs of slowing, the Fed is starting to cut rates again in hopes of supporting the economy. These policy shifts ripple through every household. Mortgage rates have dropped, making homeownership more accessible for some, and monthly payments a bit lighter for others. But not all borrowing gets cheaper at the same pace. Credit card interest rates remain stubbornly high, leaving many families still struggling with expensive debt. Meanwhile, savers are still able to find decent returns on their deposits, especially compared to the rock-bottom rates of the past, giving retirees and cautious investors a bit more breathing room. Yet, for those who need to borrow, the pressure hasn't fully eased. Many are still feeling the squeeze of higher monthly payments and tighter budgets. When rates are low, investors start searching for better returns, often moving their money into riskier assets like stocks, real estate, and especially cryptocurrencies, hoping to outpace inflation and grow their wealth. This risk-on environment can fuel dramatic rallies in Bitcoin and other digital assets as more people pile in, chasing higher profits and new opportunities. But the impact of these rate changes isn't felt equally. Some people and businesses benefit from cheaper money and rising asset prices, while others, especially those with lots of debt or fixed incomes, can get left behind. That's why understanding how the Fed's decisions ripple through the economy is crucial for anyone involved in crypto or investing. It helps you anticipate where opportunities and risks might emerge. The Fed's next move could open the door to your next big opportunity, or expose you to new risks. Staying informed and adaptable is key in this ever-changing financial landscape. The Federal Reserve, often called the Fed, has a tough job. It's responsible for keeping the economy on track by balancing 2 critical goals: making sure as many people as possible have jobs, and keeping prices from rising too fast. This balancing act is at the heart of every decision the Fed makes, and it's never easy. Right now that balance is more precarious than ever, like walking a tightrope in a windstorm. Every move the Fed makes is watched closely, and the stakes are high for everyone. Unemployment has crept up to 4.6%, and job growth is slowing. For many families, finding work is getting harder, and layoffs are becoming more common in some industries. At the same time, inflation remains stubbornly above the Fed's target. Everyday essentials like groceries, rent, and gas are still costing more than they did just a year ago, squeezing household budgets. To help support jobs, the Fed is cutting interest rates, hoping to make borrowing cheaper for businesses and consumers. Lower rates can encourage spending and investment, which can boost hiring, but every rate cut comes with a risk. It can also fuel inflation, making prices rise even faster. The Fed has to weigh these risks carefully, knowing that the wrong move could make things worse. On top of that, President Trump's tariffs on imported goods have pushed prices higher, adding another layer of complexity to the Fed's challenge. All these factors make the Fed's job even harder. Inside the central bank, policymakers are debating fiercely about the best path forward. there's deep division. Some officials argue for more aggressive rate cuts to fight unemployment, while others worry that too many cuts will let inflation spiral out of control. Every decision is a trade-off. If the Fed cuts rates too much, the value of the dollar could weaken, making imports more expensive and potentially hurting the economy in other ways. But if the Fed holds rates steady, unemployment could keep rising, leaving more people out of work and slowing economic growth. Financial markets, and the fast-moving world of crypto, are hanging on every word from the Fed, trying to anticipate what will happen next. Investors and analysts are constantly reading between the lines, searching for clues about the Fed's next move. Officially, the Fed says it plans only one more rate cut in 2026, signaling caution and a desire to avoid stoking inflation. But many investors are betting that the Fed will be forced to cut rates more than that, especially if the economy weakens further. This gap between what the Fed says and what the markets expect is creating a recipe for volatility, sharp swings in stocks, bonds, and crypto. For crypto holders, these wild swings can mean the chance for big gains, or the risk of sudden painful losses. The uncertainty is both an opportunity and a threat. That's why staying alert to the Fed's signals and understanding the forces at play is more important than ever for anyone in the markets. The stakes have never been higher, and the next move could change everything. The Fed is supposed to be independent, but President Trump is rewriting the rules. He's openly pressuring the Fed for lower rates and plans to replace Chair Powell with someone who'll deliver. This political interference is now a market force, not just a headline. Investors are pricing in a more dovish Fed, one that keeps rates low, even if inflation rises. For crypto, this could be huge. A weaker dollar and easy money make Bitcoin's digital gold story even stronger. If the Fed's independence erodes, more people may turn to decentralized assets as a safe haven. The Trump factor isn't just politics, it's a potential crypto catalyst. The next Fed appointment could change everything. Black swan events, rare, unpredictable shocks, can upend everything, often when we least expect it. Today's mix of political pressure, economic slowdown, and Fed uncertainty is fertile ground for surprises and sudden shifts. A sudden aggressive rate cut or a spike in inflation could send markets, and crypto, into chaos in a matter of moments. You can't predict these events, but you can prepare, diversify, avoid over-leverage, and stay nimble in your strategies. In crypto, resilience and adaptability are your best defense against the unknown and the unpredictable. Not all cryptocurrencies react the same way to shifts in the global economy. Each coin has its own unique drivers, and understanding these differences is crucial for anyone navigating the crypto landscape. Take Bitcoin for example. With its fixed supply, Bitcoin often shines brightest when the US dollar weakens and interest rates drop. In many ways, it's seen as digital gold, a store of value in a world where central banks are printing more money and traditional assets feel uncertain. Aggressive rate cuts by central banks can spark another Bitcoin bull run, as investors look for alternatives to cash and bonds. But it's not always a one-way street. If a deep recession hits, fear can drive people to liquidate even their crypto holdings, causing Bitcoin's price to dip temporarily as investors seek safety in cash. XRP, on the other hand, is closely tied to the world of global payments and cross-border trade. Its value is influenced by how much money is moving across borders, and how efficiently those transactions can be processed. When interest rates are low, commerce and international trade often get a boost, which can increase the demand for XRP as a bridge currency. But if a recession slows down global business, transaction volumes can shrink, putting pressure on XRP's price and utility. Of course, macroeconomic trends are just one piece of the puzzle. Technology upgrades, regulatory changes, and the pace of real-world adoption all play a huge role in shaping the future of both Bitcoin and XRP. Sometimes, a major legal victory, or the launch of a groundbreaking new feature can have a bigger impact on price and sentiment than even the most dramatic moves by the Federal Reserve or other central banks. The crypto market is a complex web of influences, macro and micro, global and local, technological and psychological. Every factor can ripple through the market in unexpected ways. That's why building a diversified, well-researched portfolio is so important. It helps you weather the ups and downs, no matter which way the winds of policy or innovation blow. Don't bet everything on one scenario or one coin. Stay flexible, keep learning, and always be ready to adapt as the crypto world evolves. As 2026 approaches, crypto faces a storm of economic and political forces. Trump's push for ultra-low rates, the Fed's balancing act, and the risk of black swans all shape your investment landscape. There are no guarantees, only the need to stay prepared and informed. At Crypto Insider, we cut through the noise to give you clear, actionable insights. The best investors are the best informed, always learning, always adapting. Make knowledge your edge in a volatile market. Stay with us to navigate the future of crypto with confidence.